Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for February 15th, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Ned Damon, who's our Principal Data Scientist, Dean Croak, Principal Industry Analyst, and we have a very special guest this morning. We have Omar Singh, who is President and CEO of Surge Transportation. Good morning, gentlemen.
Good morning.
Good morning.
Really great to have you, Omar.
Yeah.
Great to be here. Thank you for inviting me. Really happy to be on the show. So thank you.
So the big question, what was better, Super Bowl or the Valentine's Day?
Oh, I think there's only one way to answer that, right? So Valentine's Day.
I saw your wife in the frame earlier.
Yeah. So yeah, she's listening to me. So.
Right.
I thought it was a good game. I mean, I didn't have a rooting interest in either team, but I thought it was a good game. I thought, some big plays, some decent commercials, and
yeah,
I'm in that right age bracket for the halftime show.
Good close game,
Yeah.
That's what you want. So
we'll see.
Down to the wire.
So just some housekeeping items at the top of the show. We'll be sending out a listener survey. We mentioned this in the last couple of weeks as well, just to learn more about what you want to hear, well, who you are and what you want to hear about. That'll help us greatly. I'm going to put a call out early for questions. Omar has nearly 30 years of industry experience. He's a licensed CDL driver, former owner-operator. He knows this industry. So if you have any questions, please drop those in the chat or comment section early so that we can get them sorted and get them ready for the end of the show. So I'm going to ask Omar real quick before we dive into the typical format, just to introduce himself and talk a little bit about Surge, if you don't mind, Omar.
Sure. Yeah, I appreciate the opportunity for being here. So again, thank you for having me. The president and founder of Surge Transportation. We are primarily full truckload brokerage operating all over the United States and cross-border Canada. I got into this really as the first job out of high school. I thought I would be able to make a little money moving furniture, and my boss took me under his wing and very quickly started driving straight trucks and then tractor trailers. Ended up doing that to pay for college and kind of fell in love with driving. So after I graduated to be a teacher, I bought a truck and I drove over the road for a couple of years. Very quickly, all of my friends were drivers and thought it'd be a great idea to start a trucking company. So I ran that company from 2003 to 2010, kind of bled out after the recession, and then got into brokerage, developed a business model that Surge now kind of went out of business selling on price, and sort of learned how to do it a little bit differently in the second iteration of brokerage, and took Surge independent in 2016 from the large national firms, and things have been going great. We have a model that really resonates. It's a little bit different than what a lot of our competitors do, and it's catching on. So we're having a lot of fun.
I like that, Omar. You've been doing enough media where you tease what we're going to talk about later. You tease that the business model is a little different, and then we're going to go away and come back. So with that, I'll take the cue. We're going to hit our key points of the week. So spot market, the rates are lacking direction a bit. I love the way Dean put it here, just sort of middling about. We've had some weather. We've had some congestion. We've had northern border crossing issues. So this is a really abnormal, I'm going to say this really awkwardly. Rates haven't went down nearly as much as we would have thought seasonally in January, and Dean will explain why here in a few minutes. Contract market, you really are seeing that glut of new contracts coming into place, with the replacement rates being significantly higher than where we ended up in 21. And then West Coast port congestion, easing a bit. I wouldn't say that it's loose, that you can just sort of call up and get drayage capacity and get things moving, but certainly not as bad as it was. So with that, I will turn it over to Dean to do a much better job of explaining what's happening. Dean?
Thanks, Ken. So we'll do a quick market update this week so we can get to Omar's piece at the back end, but we'll go through the highlights. Just remember that the long form version of the report with all of the detail is at dat.com/market update. You can download that on Wednesday evening. So let's start off with the load to truck ratio. In dry van, load post volumes were up 2% last week. That's 3 weeks of gains in the dry van sector. So the load to truck ratio decreased very slightly to 7.77. In the refrigerated sector, there was a bit of a surge in load post volumes last week. Volumes decreased compared to the prior week, but there was a little bit of an uptick. So not a lot of movement. The load to truck ratio decreased very slightly to 14.93. And in the flatbed sector, better week weather-wise, load post volumes were up 7% week over week. So the load to truck ratio, again, just moved up ever so slightly to 74.82. So not a lot of movement in load to truck ratio this week. Ken touched on port congestion. We've been watching this for about 18 months. Port markets have a direct correlation between import volumes, load post volumes on the spot market, and spot rates. In Los Angeles, congestion does appear to be easing. Import volumes are decreasing. Spot rates have dropped in Los Angeles by about 30 cents a mile. That's the average in the last month, now averaging just over $3 a mile. One of the lanes I've been watching that competes heavily with intermodal is Los Angeles, Chicago. Rates have cooled considerably over the last month. After reaching a high of $3.29, excluding fuel in December, they've dropped 42 cents a mile to $2.87 this week. That's Los Angeles, Chicago. So some pretty steep downward movement there. On the other lane we watch out of Los Angeles is the big warehouse market, ideally suited for imports from Asia between Los Angeles and Phoenix. After increasing incredibly last year, they've dropped back to an average of $4.36. That's 45 cents a mile. Down since the high of $4.81 in December. Having a look at the refrigerated sector, last week the USDA reported a shortage of trucks in eastern North Carolina for sweet potatoes, and basically potatoes anywhere in the country. There just seems to be a lack of trucks to move those this time of the year. In North Carolina, spot rates for reefers were up 10 cents a mile, averaging $2.65. Potatoes out of the Red River Valley, capacity was very tight. Spot rates were up 26 cents a mile last week, averaging $4.24. And as expected, capacity was very tight outbound out of Miami ahead of Valentine's Day on Monday. Spot rates were up 20 cents a mile in Miami to an average outbound rate of $2.11. Loads to Atlanta were up 34 cents a mile, averaging $2.14, while loads from Miami to Hunts Point, New York dropped back slightly to $2.63, still 33 cents a mile higher than this time last year. Having a look at flatbed, loads moved across our DAT freight network were up for the fourth week in a row, now up 24% month over month, which is slightly unusual for winter. On our number one flatbed lane between Houston and Fort Worth, loads moved increased another 9% last week, up 38% in the last month. Still plenty of capacity in Houston, though. Spot rates have been fairly flat since June last year, averaging $3.23. This week, that's still $1 a mile higher than this time last year. And on the steel lane from Gary, Indiana to Pittsburgh, spot rates hit a new 12-month high last week of $4.19. Wrapping up our market update with our year-over-year look at spot rates in the dry van sector. Spot rates have only decreased by 6 cents a mile in the last month. Last year, they dropped 33 cents a mile in the first 6 weeks of 2021. Last week, they decreased another penny per mile to an average of $2.71, still 32% higher than this time last year. And in the refrigerated sector, after dropping 9 cents a mile in the last 4 weeks, spot rates were flat last week, even though the volume of loads moving in our network increased by 3%. The national average reefer spot rate ended last week where it started at $3.07, excluding fuel, still 70 cents a mile higher than this time last year. And lastly, in flatbed, flatbed spot rates have been just that, flat, since the start of the year, after decreasing by a penny per mile the week prior. Last week, they increased by the same amount, leaving the national average at $2.66 per mile, excluding fuel, still 44 cents a mile higher than the same period last year, and 61 cents a mile higher than the same time in 2018 as that flatbed rate rally got going. So that's it for this week's market update. Remember, you can go to dat.com/market update and download our weekly report. And with that, it's over to Ned for the short-term forecast.
Hello, everybody. We're going to start off with dry van. In blue, you can see the market rates observed by DAT, and then off to the right, you can see our forecast models. In red, our short-term model is expecting the current slightly downward trend to continue, dropping rates by about 10 cents over the next month. In green, our ratecast model is expecting things to stay flat for a short period and then lift as we head into the later part of February, maintaining a level about 5 to 8 cents above current value as we go forward. The blended forecasts in gold and silver, which are mixtures of the short-term and the ratecast model in different amounts and in different ways, are expecting that the rates are going to continue at about present levels, dropping a little bit with no net movement up or down. Moving next to reefer, we can see that once again, the blue line is the spot rates observed by DAT. And then off to the right, there's pretty broad model agreement heading forward through the next little bit. Once we get past the later part of February, it looks like we're going to be moving into a period where the short term is expecting in red rates to maintain about their current level. The blended forecasts in gold and silver are leaning very closely towards the short-term model, and RateCast is expecting a lift of about 3 to 4 cents per mile. Finally, moving into flatbed, once again in blue, we can see the market rates observed by DAT. In green, RateCast is expecting rates to rise pretty considerably, again, about 7 cents. As we move through the next period. The short-term model, in contrast, in red, is expecting rates to drop pretty significantly. I'm not sure how much I buy that trend. And then the blended forecasts in gold and silver are leaning towards the short-term model more, although overall they're expecting rates to maintain about their current level, maybe with a small drop in the blended forecast version too. And that will bring us to our DAT IQ question of the week, which I have right here if I can read. It's difficult sometimes. How have routing guides changed during COVID?
So thank you, Ned. I'm going to break this into some chunks here. So first of all, we talk a lot about routing guides here, and if this is remedial for some of the audience, I apologize, but we have some folks that are maybe new to the industry or from a carrier perspective don't have visibility. So Omar, could you walk us through what is a routing guide, like in a very succinct industry explanation? Like what is a routing guide at its core?
Yeah, at its core, most medium and large shippers will hold an RFP event and get, say, 100 or 200 motor carriers to bid on their forecasted volume for the year, and submit rates. And they'll typically, on a blend of price and service level, select 4 to 5 carriers to be in kind of a waterfall selection of getting the tenders when the shippers have those loads. So they'll set up a network of carriers and say, okay, these 5 carriers are going to be on my Jacksonville to Chicago lane, and they can set it up for either like a percentage allocation and say all 5 carriers are going to get 20%, or I'm going to go with the cheapest first, and if they reject it, then we'll go to the next cheapest, and then to the next cheapest, and to the next cheapest. And then that's their guide for their entire network. For every lane that they have, they'll have 4 or 5 people who are selected to be the service providers on that lane. And that's what they call the routing guide.
And that's usually due to price, right? So let's just take an arbitrary market where the number 1 carrier on the routing guide is $2. You would expect the number 2 carrier to be something like $2.10 or $2.15, right?
Yeah, usually. And of course, it depends on how mature the network is and how, sort of established those providers are, and how much weightage any individual shipper wants to give to the service level or drop trailers. Maybe there'd be a huge disparity in the price between number 1 and number 2, because number 1's giving them drop trailers and number 2 is giving them live loads. So, there's certainly, unique nuances of each lane and each provider, but yeah, usually on price.
And one common misconception, right, is that not all, and this doesn't happen with every shipper, but it doesn't, let's just say there's 5 carriers on the routing guide. Once the 5 carriers have rejected, it doesn't necessarily go straight to the spot market. They may have like a backup list, or like a pinwheel of carriers that they may go to after the 5th, right?
Yeah, very much. And and that's to a very large extent our business model is to position ourselves there at the end to stop them from having to go to spot, and essentially say, you really want a business continuity provider that's going to establish reasonable rates that everybody's comfortable with, but sort of, on a 100% tender accept relationship, so that you guys know, you can focus on other things and your business continuity is always there. And it's pre-negotiated, so everybody's kind of comfortable and understanding. It might be a short lead time environment or challenging, weather events, something going on. Now, just kind of the root of the question, since COVID, have you seen more of a shift down the route? So your business model, as you kind of teed it up, is that lower end of the routing guide, because you provide that backstop without having to go full on spot market. Have you seen the industry shift further down with the capacity situation we've seen the last 2 years? Well, I've seen both, right? Both a shift into further down, because primaries just the market's been changing so much since the supply chain disruption, COVID, that primaries haven't been able to, service their commitments, whether it's price change or just not having capacity. But also I've seen a really big shift toward API pricing, and a lot of large shippers are saying we're going to stop going to the routing guide and go to the APR market, or we're just going to designate certain types of our freight, whether it's low volume, and some people do it as high volume. So we're going to send this to our API providers because we need a right now rate, like immediately. And so it's a little bit of both. But yeah, definitely less primary and more, secondary, tertiary in some form or another, whether it's a published rate or an API rate.
So I'm sure Ned's going to have a follow-up question on this, but from what I've heard and seen in the industry, Surge has largely invested in some of these API pricing tools, even when you were sort of, I don't know how to word it, like you would expect the big names, like the top 10 brokers, to have a lot of these technologies. And I don't think a lot of brokers that, I don't want to say your size because you've grown so much in the last couple of years, but like your size when you entered down this path, it was kind of disproportionate how much you were investing in this, but it really seems to have paid off. So what advice and kind of how did you think about investing in that technology ahead of your growth?
Well, I think for, the things that keeps business owners up at night, right, is kind of how am I going to stay relevant in 2 years and 5 years and 7 years? Because I already went out of business once, very bad experience, and I don't want to do it again. So when kind of was able to recover the career and reestablish a new company, kind of always forecasting how can I make sure that doesn't happen again? And I knew that APIs and real-time pricing were very much, the new wave. If you get kind of the traditional digital brokerage starting to take up a lot of market share, and you see the customer adoption for all of those technologies and their willingness to say, yeah, we want to give this a shot. We need real-time rates. We need real-time capacity. And so honestly, one of our larger customers is the first one who gave us the opportunity to say, we have something that we call our dynamic rate tree. We can give you the specs for how to participate. Are you willing to do it? And that's a no-brainer, jumped right all over it. And then was able to kind of take that and then develop the capabilities of integrating with Blue Yonder and Blue Jay, Mercury Gate, Oracle, Cubix, and start really going after the TMSs. And it's made a huge difference for us. But if advice you asked, I mean, invest in technologies. I think we're all going to need it to be relevant, 5 to 10 years from now.
Sorry, not to jump over you, but something that you said about real-time rating, something that I've been interested in personally is how the line between spot and contract is really blurry. When you started talking initially about like contract as pre-negotiated freight, and people are trying to avoid the spot market, but then, in the next segment, you start talking about APIs and real-time rating. To me, that's really interesting that essentially it's sort of Spotifying contract in a certain sense.
Yeah, to a certain extent it is.
Yeah.
I mean, I actually think that, 5 years, 10 years down the road, I think routing guides are going to be digital. I think that shippers are realizing that they're going to have to just operate in a market environment where it just kind of is what it is, right? And hopefully the conditions are favorable and they can save on cost. But at the end of the day, you need capacity, right? And if we do a lot of consumer packaged goods, and the reality is, prices are up in stores, right? So if transportation costs go up, they can just change, the price of their product, and everybody's okay. So the freight has to move,
right?
And I do think, and so much like short-term market changes, whether it's weather events or our beer customers, a huge push for Super Bowl. There's a lot of extra freight there, and at the same time, you got bad weather. It just changes a lot more than I think it used to. And the driver shortage is a little more real.
Yeah.
I think it's just such a huge fallacy in the industry, right? We love to get enamored in this sense of the digital brokers. And I hope I'm not offending. I love digital brokers. I guess my point more is that we have a partner of ours, it's Mystic, a guy by the name of Sean. I don't think anyone would label them a digital broker, but they're doing some of the absolute coolest things with data. They've invested in technology, they've invested in some kind of high-powered data analysts or developers, and they're looking at things of like sensitivity to rates, the load-to-truck ratios, and other industry signals. And Then I've also walked through the brokerage floor of some of the biggest digital brokers in the world, and there's hundreds and hundreds and hundreds of individual brokers sitting there. So I think it's really just a mix of like the digitization of our industry and what becomes table stakes, right? APIs, TMS integration, dynamic pricing. I think these things are all becoming like shifting from novelty to minimally deployed to table. And I think in the next few years, they'll probably be table stakes for a lot of, I would certainly think any broker larger than $50 to $100 million, wouldn't you think, Omar?
I think so. I mean, I think it's going to be necessary. It's going to be expected, to be able to just have access to the freight, because our customers who are using it are really just sending a lot of freight to the digital API providers, and the brokers who don't have access to that freight, I mean, they just don't have access. They're not being invited to participate in a manual traditional environment.
So Surge is a mixed model, right? You have assets and you have the non-asset side?
No, we do not have assets.
Okay, so you don't have assets. My bad, sorry.
Right.
So traditionally, at least when I was in the industry, you had a very common like 5-1 model where you had 5 asset-based carriers and a broker in your routing guide. That was a kind of a more progressive model. We're hearing more and more that big shippers are thinking about doing like a 5-2 model or a 4-2 model and maybe adding a second non-asset provider. Are you seeing any of that when you're out there sort of looking at bids and talking with shippers?
I think so. I mean, I would say, and I always say not all brokerages do the same things, and they don't have the same strengths or even the same business model. So a lot of times we'll get, a large shipper will say, well, we already work with XYZ broker. Why would I add another one? Well, because maybe they don't do all of the same things we do. And it's great for you to partner with, if you have a diverse network, different people who have strengths in other areas, that's good for you. You should diversify your brokerage base. So I'm all for it on a strategic, just execution standpoint. But I think there are also a lot of people in the space right now that are able to operate at a, negative margin because they're taking up market share and they have outside funds to be able to do that. And I think it's hard for shippers to ignore that. So on the traditional, I can really come in and save you money. It's hard to ignore that. So they're able to really kind of dig in and take up market share that way. I don't know how long it lasts, but there's certainly always an audience to somebody saying, I can do it for less. So.
I'm interested in, and again, don't feel free to leave out whatever your secret sauce is, but targeting deliberately, pardon, the tail end of the routing guide. Is it that like you're deliberately, when you have a traditional bid event, targeting well above what you expect the going rate on the lane is, or how do you kind of position yourself to make sure that you're at the tail end of the routing guide and you're not ending up higher?
Well, it's a conversation. It's always a collaborative conversation with the customers. And I think in a more stable market, we used to do something that was very popular. We did lane weighted average plus 10%. So lane weighted being you take, your top 4 providers, you average their rate and say, okay, that's going to be pretty market, and we're expecting you to operate in short lead time environments. So let's just tack 10% onto that, because that's what brokers should be making. And everyone was comfortable with that, and it kind of worked. In the last 2 years, it's been a little bit less stable. And so that, rates are up way more than 10%, right? Mm-hmm. So I think it's just a collaborative conversation with shippers about what makes sense. And then you can also put different time periods on some of those backup rates if they're not API. So we are really moving to 60 and 90-day rates rather than 12-month rates. And so I think we can forecast that a little better than a 12-month at this point.
Yes.
So, yeah.
Speaking from personal experience, it is a lot easier to forecast going out 3 to 6 months than it is to forecast the full 12.
Right. So, and really have to be able to have collaborative conversations. And I mean, I hate to admit it, but sometimes we're at the point where we say this rate is good until it's not. And then we'll let you know when it's not. And I mean, that's the best we can do. I wish I could tell you what it's going to be like 6 months from now. And I'm gonna hold it as long as I can. And we're also happy to share our financials with our customers to give them a report and say, obviously we all need to have a profitable business, but we don't want to be overcharging, and we also don't want to go out of business because we don't have enough. So we're happy to always say, kind of this is what's working. And sometimes we have big losses, sometimes we have big wins, but really at the end of the day, I mean, our company closed 2021 at 9.88%. So it's sort of kind of right in line with the expectation of what, and of course, out of that, we have operating expenses, so,
right.
But it's, and that's reasonable. Most shippers will look at that P&L and say, yeah, that's reasonable.
So a couple big seminal questions before we move on, Omar. Will we exit the year with any sense of normalcy around spot contract percentages? In other words, will shippers be able to muscle their routing guides back into shape?
I don't know if it's going to be a year, to be honest with you. I mean, I really think I'm having a hard time saying, yes, there's going to be this huge correction. I mean, capacity is coming back into the market. I kind of do this like very basic analysis of our, population grows every year. And if the number of drivers decreases every year and the population grows, when it grows, we consume more. When we consume more, there's more freight. I kind of have a hard time predicting that it's going to be this massive correction and things are going to stabilize again. I think real-time rates and APIs are kind of, the market's going to shape shift a little bit more frequently than it used to, I think. But I mean, you guys are the experts, So.
Well, we play ones on TV. So the last question I have is, when we exit this year, if you think about December 31st, what will the year-over-year spot rate percentage look like? Positive, negative, or flat from where we exited 21?
I think it's going to be higher than, or maybe flat to 21. I don't see, in terms of tender rejections, being at around 20%. I have a hard time seeing them go back down to 10% average. But
solid. So I think we did such a good job of preempting all questions. We only have one, I think, unless we lost connection with Ben. But Ned, you want to read that one?
Certainly. Tanya Wood asks, how do you mitigate the risk of no-shows? Are they normally dispatch or driver related?
Is that for me?
It's for anybody. You want to pick it up? Yeah.
I'm sure Dean will have something to say on it too.
We try to get drivers on tracking hours before the pickup appointment. So that's, I don't want to know at the hour that you're supposed to be there if you're there. I want to know 5 hours before you're supposed to be there if you're within 2 hours of getting there. So we really focus a lot on tracking and making sure that no surprises are there and communicating. So.
Dean?
It's just a follow-on question. It's got to do with dwell time and the inefficiencies and the impact on capacity. Since the labour shortage became very persistent on the dock side of the shipper receiver transaction, we've seen drivers spend a lot more time waiting to unload and load. Sometimes they get detention, sometimes they don't, but it just soaks a lot of capacity out of the market. And I just don't know that carriers are fully compensated, drivers are fully compensated. But my question, I guess, is how do you factor into the rate negotiation discussion what should really be a surcharge for dwell time, unpaid dwell time? Because in the ELD era, every hour you spend on a dock is opportunity cost for both the carrier and the driver if they're not being compensated.
Yeah.
I think this year has proven that time is money more than any other, even more than ELDs, frankly.
Yeah.
So, Omar, where can they get in touch if they want to learn more or set up a meeting?
Well, yeah, I mean, there's a lot on our website. We'll direct you. If you're a motor carrier, we'd love to partner with you and develop strategic relationships. And if you're a customer, then a shipper, real-time at Surge Transportation is one of the emails we use to onboard APIs, but there's also info. And I'm, super accessible on LinkedIn or first name, last name at Surge Transportation for all of us. So
awesome.
Yeah.
Dean, what do you have coming up? Oh, besides your big, I won't disclose the location, but Dean has a nice little vacation planned.
Yeah, heading overseas for a short vacation, but I'll be on Landline Now tonight at 7 p.m. Eastern, and on with the Canadian brokers on Sales Chatter at 9 a.m. Tomorrow morning, live on LinkedIn and YouTube at 9 a.m. Eastern.
And then Ned, you wanted to give some thank yous to those that reached out?
Yes, Sean, Patrick, and Hunter. Thank you. Thank you very much for sending me things that I can run through the new model. It's been really
we should ask Omar to have one of his pricing folks. We're testing out a new lane-specific or a shipment-specific pricing model that takes into account like hazmat, pieces, dims, weight, pickup, lead time. And we asked folks a couple weeks ago to send in 100 or so lanes with all that specific information, and Ned would run it through the model to score. So maybe we'll have to get that over to you to test out.
Yeah, I'd love to do that.
Yeah.
Cool.
So with that, we will be here next Tuesday. I want to thank Omar. We'll have to make this a quarterly thing or something because this was a really great discussion. Anything that kind of brings us closer to the industry and can help educate folks, I think is just well worth the time.
Yeah,
so we thank you very much for joining us.
You're welcome. Happy to be here.
All right. We're going to sign off for this week, and we will see you next Tuesday at 10 a.m. Eastern. Bye, everyone.
Okay.
All right, everybody. Okay.